So in this session, we're going to talk about the three cost control mechanisms. You really have two parts to those three. The subcontracts and purchase orders for your committed costs, and then your job status hours. And we've covered some of the screens before. Let's kind of go through them again real quick. So when we look at our reporting on our commitments, this dashboard report, the billing commitment analysis, will give us the commitments by vendor cost code on the project. It'll tell us the total of the commitments. It'll tell us what we have left to be billed from the sub or the supplier. It'll tell us any AP that came in on the project from that sub or supplier that was not tied to a commitment, which can be an exception report. And then it'll give us a column where we can see the total invoices. The drill down reports include the invoices, the itemization of the invoices. And it includes this particular, if you click on the first column, you'll get the commitment and itemization of the invoices and itemization of any payments, including the accounts payable. Okay, so this would be the purchase orders and subcontract reporting. Another way to show that the POs and subcontracts, there's several reports, but another way to look at it would be through the job status concept. And this is going to display the commitment or PO subcontract by phase cost code. Okay. So for example, that one item, if we look at our columns across the top, original budget, change order, revised budget, revised total commitments, cost on the commitments, job state cost, and then there's a column for period, estimated cost to complete, our variance. That change order one was here. If I click on that, it'll give me a report, basically the same type of report, but we were doing it by phase cost code. Okay, so if we go to the standard drill down or the standard dashboard report, we go to the golden job, the variance column will give us one of the job status reports, similar to the one we just looked at. Okay, so that column gives us our original budget, revised budget, committed cost, committed balance, actual cost, percent complete. So just one of the variance reports, okay? So through the variance reports, whether it's at this level, the overall phase cost code level, or if you drill down, you can get the by type level, right, with your variances. You use your committed cost and your labor hours status report, and that was here, not here. Our status report was behind this projected column. Let that come up in the background. Okay, so then we're able to buy hours, budget hours, actual hours, percent of budget, produce a worksheet that your field or project manager can, superintendent, foreman, project manager, someone familiar with the project can come in and put the percent complete on. And then if you would use this job status grid as an accountability tool to project where you're at with the project. So based on the percentages they give you, you're going to take your adjusted budget and project your total estimated cost, so you have a variance, weekly variance of where you're at on the project. So then you've got the information coming back from the field. And weekly accountability reporting. So then and we'll talk about a couple other concepts in this webinar, this is session 3. Where in the income statement is the difference between the job cost reflected in the job cost reports and the job cost that hits the general ledger? So you have two processes for, that you're accounting for: your double entry system of accounting for your books, and then you have your job cost reports. And your job cost reports, the jobs get burdened, whether it's labor burden or indirect burden through percentage burden. And so you want to be able to, when you produce your job cost reports, you want some sort of assurance that the numbers you're looking at in your job cost reports are consistent with the numbers that are on your income statement, right? And so tying your books, your job cost into your income statement or your general ledgers becomes important, because then your general ledger is a double entry system of accounting, which includes a bank reconciliation, and it includes, hopefully a test of balances every month, so the accuracy of it is maintained. So if the accuracy of your bookkeeping, your accounts, your accounting, your general ledger is maintained, that will ensure that your job cost is accurate. Okay, as far as the totals are concerned. So if we come over here to the income statement and we print out your income statement, and you've got your 3 sections of costs, your 3 types of costs in your income statement: your direct costs, your indirect costs, and then your home office or operating expenses. So then you want to be able to tie your job cost into your income statement to prove your job cost. And so the summary contracts, what we've done here is we've got this job status report where we're projecting that we're $252,000 total cost on this, right? So we come over here to the summary contracts, which is the report that allows us to basically tie our job cost into our general ledger. And it also gives us the ability to produce over-under billings so that our revenues and costs match. So in Accounting 101, first class in college, first 2 weeks, they teach you about the matching principle, which is crucial. And construction, they don't teach you much about construction accounting, but they'll teach you about the matching principle. And this over-under billings, this concept is all about the matching principle. So, and the concept behind the matching principle is that if I look at my income statement and my costs and the margin on those costs match my billings, then I've got an accurate financial statement. Okay, so if I start a new company, for example, and I incur $25,000 in costs before the end of the month and have 0 billings, I'm going to print out an income statement. It's going to say 0 revenue, because whenever I do a billing, it hits my revenue accounts. It'll say 0 revenue, $25,000 in costs, loss of $25,000. Even though I worked hard all month, I started a new business, incurred $25,000 in costs on a project, my income statement is inaccurate because it's saying I lost money. In reality, my margin on that $25,000, let's say, is $5,000. So I've really made $5,000. So if my revenue shows $5,000 here, 20 or $30,000 here, $25,000 here, and a $5,000 profit, then it would match, right? So the billings there's some over-under billings adjustment that has to take place on the revenue account to get the billings, get the revenue to match the cost plus the markup on those costs. So if you look at this format of the summary contracts, you've got a cost date, and this is the number that we're going to look at, and we'll see it ties in here, the 107,331, and it'll tie perfectly as long as you do a few things with your jobs that carried over from the prior year have to be set correctly and tie into the financial statements that you finished for the end of the previous year, usually a reviewed, audited, or compiled financial statement from your CPA firm. So that would be the first step. The second step is you have to accrue wages, right? So your utilities accrue wages. So the wages, the labor you'll see on your income statement is based on check date. All the labor in your job cost reports is based on work date. Okay, so your job costs have all the labor through the end of the month, or at least based on the days you key it in to your payroll, but the general ledger won't have that, so you have to accrue wages. So you go utilities, accrue wages, and this is crucial. Accruing wages in accounting is a daunting task as an accountant to do it perfectly. So we'll pick our cutoff date, we say post and preview. And the reason it's a daunting task is because every time card row has FICA, FUTA, SUTA, work comp, general liability insurance, 401k, whatever. So you have all these accruals relating to every time card row. And in order for your job costs to tie out perfectly in your summary contracts into your income statement, you have to perfectly accrue wages at the beginning of your fiscal year and perfectly accrue wages at the end of your fiscal year. We don't have any competitors that do a full summary of contracts. Like in our market, there are, I don't know, 8 or 10 companies pretty much that we compete against. And no one does percentage completion financial reporting with the full summary contracts, and you would think that that would be like the first thing everybody does. And from an accounting perspective, I'm a CPA and I practiced in accounting for public accounting for 18 years. I would think that that would be a construction-specific system. Over/under billings, full job tie-out into the income statement would be one of the first steps you take. But I guess it's so complex, probably because of this process, that they could never get it done. So anyway,
Eric?
So it's something. Yeah.
Eric?
Yes.
Hey, when
Go ahead.
you, I noticed you've been kind of flipping back and forth with this job status and about updating, the jobs through the job status profile. But then I did note that, with the over or under billing mechanism, you can do the recalculate or by status. And I noticed just on the last one, you had the recalculate option clicked versus the status. If our managers are doing it by the status on some jobs and maybe not on others, will that mess things up, or?
Yeah, you have to do it based on the status. The status method will be exactly what the budget is unless you've changed the status. That's how the system's trained.
Okay.
So if you do status, you're safe on all of them. The
Okay.
status is exactly what the budget is.
So you're going to have, so what you need to, so then what you're saying is basically you got to determine, okay, how are we going to do it? Are we going to do it through the status, or are we going to do it through the budget windows, and then go that way?
The status one should be the default. It really should.
Okay.
So, and so I usually just try to mark that, but we don't have that set as a default. We will someday. We'll do that at some point. We'll make the default. So, jobs of any duration, the status makes a longer duration. The status makes sense. If it's a real short-term job, budget actual variance at the end of the job is probably as good as you're going to get.
Yeah, the only thing I think with that status, like I think I had mentioned in our previous session, was that one thing I like to do is adjust those labor hours, so I can see the labor hours, as those are getting kind of changed, and you don't have that window.
You can download that to Excel and get it to do your percentages that way if you want them based on labor hours. So.
No, as we
we do have
like as you adjust the budget hours, like, okay, we added 100 more hours in change orders, so instead of from 1,000 hours, I have 1,100 to play with. You know what I mean?
We do have an update to that. We just we do have an update to that screen. We just haven't put it in the general release. We have a few users with it, so I can give that to you. Just give me a call, and I'll give you that adjusted screen.
All right.
So. Okay, so the over/under billings really needs to be based on the status. So in our example, for sure, right? So now on this project, we're at a total cost $252, and here it says $256. Did we? Oh, maybe I didn't hit save. So 252 there, 252, 694, okay? 252, 694. Okay, so then our over-under billings will be accrued and tie into our income statement after that 111 will become our revenue number. So the utilities, accrue, over-under billings, status, calculate, and post. And then refresh the income statement and our revenue will tie in. It does our accrual and our reversing entry, hit the lightning bolt, and then our revenue ties into our summary contracts, our costs tie into our summary contracts. And then the question we had is what's the difference between our job cost reports, the 107,332, and the total cost of construction. So our total cost of revenue or projects is 111,000. It's not 107,000 like our job cost reports show. And the difference is our over-under allocation of indirect costs. So you'll set your burdens based on indirect costs, and you'll never be perfect. You can be perfect if you retroactively allocate it, which is what we recommend, periodically, either monthly, quarterly, semi-annually, or annually. So if we come over here to like this analysis report and we say direct costs and burdens, so in your estimating process, you guys, one thing the estimator always wants to know is what does it really cost me on my labor hour, right? So here's a report that tries to do that for you. So recaps your direct labor, indirect labor, and take your indirect costs, total them up. Here we had some indirect costs that was basically applied through a percent burden, and most of you probably use the percent burden to try to capture your indirect costs. So utilities, preferences, and burden, and you place a burden on there, right? And you're saying, okay, based on that, hopefully I get my indirect cost allocated. So I had a total, my over-under allocation was 4598. So that's the difference between my actual total construction, cost of construction, and so the 111 less the 107 is the 4,000. So if we look at a report that kind of we can ask a question, okay, so let's pull up a report. This labor performance report extended. I think it's an exceptional report because it really tells you where you're at on your labor. So, I mean, from a material standpoint, a subcontractor standpoint, it's a lot more straightforward. They're really direct costs. So what did I anticipate? Did I buy my job out? Did I sign up for purchase orders and subcontracts at the beginning of the project or as much as I possibly could? Did I track those costs? Did I create my accounts payable invoice from those purchase orders and subcontracts? And then you've really done what you can do, and I monitored what's out there and what's coming in, that kind of thing. So you've done what you can do on the cost side or on the PO and subcontract side. So here's a labor performance, and this is not just labor, but it's materials, sub equipment, and other. It's just a budget actual variance report. So budget actual variance on every job completed, right? And as far as labor is concerned, you've got two types of variances. You have the number of hours you thought you were going to have into the project. And this is demo data, so bear with it a little bit. But let's say this is done. We had 18 hours that we thought we had 400 hours budgeted, and we have a production variance. We produced it ahead of budget by 382 hours. I have a rate variance too. I have a $40 rate that I put on my labor hour, and I've got a $37 actual rate. So here's my budget, amount, hours, rate, my actual amount, hours, rate, and my variance, amount, hours, rate. So on my labor, on my non-labor, it's pretty easy. My variance is my variance, okay? So on my non-labor, my variance really gets a little more complicated. Like how much of it was relating to how well we did in the field, and then how much is it relating to the rate that we used on the estimate. So we have a rate variance of $2, actual hours of 18 times the rate variance of $2. It tells us we're $38 off on our variance was $38 because of our rate. And then the question really is how accurate is that $37 rate, right? So one of the first times I tried to recap a rate for a client practicing in public accounting. What is, the question is, what is really my rate on my labor? I took all these indirect costs and I really tried to break it down by, my labor. So I said, okay, here's my indirect cost for the year. These are the hours. I really made it complicated. And I did a demo this morning where they did exactly that, very in-depth, trying to take into consideration fuel on their vehicles, depreciation on their vehicles in the field, maintenance on the vehicles, the health insurance on the employees in the field, trying to roll that in. But in reality, at the end of the computation, you're just basically using those indirect costs and trying to individually apply them. Well, you don't really need to do that. Just pool the things correctly in your income statement. Take the total, divide it by the total of your labor, your gross labor, and it gives you a percentage. Okay, so if I throw 65% in my percent burden, I'm going to come up with a zero over-under allocation. If I would have said 65.2130, guess what would have happened if I would have done that here? I would have had no over-under allocation. Okay, so then that takes us to the next step. So if I want, at the end of the quarter, probably that would be as often as I would do it, because your indirect costs will jump up and down. Remember, we talked about the fact that your indirect costs have this variable versus fixed component. They're not fully variable with your project. So depreciation happens every month, so that's somewhat of a fixed component. Okay, you have a lot of activity on your projects, you're going to have more indirect costs. So that's the variable component. So every 3 months or every 6 months or every year, you go back and you true this up so that you can run these reports and say, okay, what really is that number? So if we were to take this, January period, true up our indirect costs, we'll see the effect. Instead of 38, we'll be looking at another number. So we come over here to, and this is not an exact science, but this is probably as exacting as you can get. So you keep it simple, divide it out, and go forward with a rate. There's an inherent limitation in the accounting process, and that you can't really take a skid steer and apply the exact cost of the skid steer to every project it's on. It's just not practical, and that's the definition of indirect cost. It's difficult or impractical to apply directly to jobs. So you want to apply as much as you possibly can directly to your jobs, because that makes it easy. But the indirect costs have to be considered. So we brought up this .NET grid, and I'm sorry for this computer running so slow. And I go into this burden utility grid, and if you don't have the burden utility icon, you can turn it on. And if you take, I can show you how to do that now, but I'll show you how to manipulate the icons on the grids. But there is a .NET webinar on the .NET grids. So, and the webinars, I think get us on the same page. So if you double-click in the icon area, any of the grids, you can click Customize, and you're able to turn on any icons you don't see. Okay. So here we're going to say Add. We'll say we'll say from date January 1st through January 31st. Okay. And if we want to do the percent burden, this grid will do journal entries. It'll allocate indirect cost pools. I mean, we really developed the extensiveness of this for like a fab shop manufacturing concern, where they have the indirect costs really take multiple forms. They'll have lots of sections, and you'll be able to you can actually generate a journal entry. Some contractors want to post their burden into a burden cost code, and this facility does do that. But I think for the most part, we just try to get our users to use the software in a very simple way while achieving what they need to achieve. So the simpler we can make, so a concept that I think is valid is the simpler you can do it while achieving your goals, the better off you are. If you keep it simple, then you're working on what's important, on the details that are taking you more time than they should. So, but depending on your situation, you might need a lot of these things. So cost to allocate, amount or percent based on, and then we're going to do the cost group. Okay. So we're not going to do an as of date because we're not going to generate a journal entry. We're going to post that percent burden concept. So the indirect cost concept, indirect cost GL accounts, we're not going to analyze those. It's not necessary. So indirect. Okay, so we're going to say a specific percentage in this case. And if you look in the monthly procedures checklist, we have this process you go to. This actually is going to replace that, so we'll update that procedures checklist. And the percentage that we want to use on that is the number that we came up with on this direct costs and burdens report. And it's telling us that we have 65.21309. Okay, so we're going to do that. We're going to say based on a cost group. Remember the difference of a type and a group. You can have multiple types per group. Labor is going to be our group. And we're going to say save. I'm going to put our checkbox there. Save again. And then we're going to execute and post. And it's going to repost our indirect costs. And even though it shows 65.21 there, the grid is designed just to display to the second digit. So the number is there, and when it's done posting, I'll show that to you. Okay, so if I click on it, it'll show me it did take it out to 5 decimal places. So I come back over here, and I've got to do a couple things for everything to tie out right. So $281 off here. Okay, one thing that just happened. Let's look at the tie out, and I'll show this report we talked about before as far as tying out to the income statement, kind of a more detailed approach. So 1/1/2013 to 1/31/2013. Okay, so by labor, material, sub-equipment, we get our income statement, and at the bottom we say general ledger versus job cost billing differences. Okay, and so we're $281 off here. Now, one thing we did is on our direct costs, we have gross labor, material, sub-equipment, and other, right? Total direct, we have labor burden, and we have percentage burden. We changed this percentage burden. That's what we just changed on the transactions. So there are hours we worked in January that got paid in February. And those accruals need to be, accrued wages need to pick up that percentage burden for us to tie out perfectly. Well, we just changed that percentage burden, which means we have to reaccrue our wages. So our accrued wage journal entry is going to change because we changed that percentage burden, so we would have no over/under allocation of indirect costs. Okay, so posted in, did our reversing entry. And there's our accrual. Okay, so now if we refresh this, we should be perfect on our tie out at the bottom. So you won't tie out if you don't accrue your wages. Another trick is if you don't accrue your wages at the end of your fiscal year, then you're not going to tie out because they have to be perfect at the beginning of your fiscal year and at the end of your period. So if you're doing it July, you have to have accrued it at December 31st, 2012, and then you also have to have accrued it at July 31st, 2013. If you don't tie out perfectly, you can do a support call, and we can help you formulate a journal entry to allow for it. But the fact is your books weren't exactly perfect at the end of the previous year. Hopefully they weren't materially misstated. And in accounting, you talk about material, that is meaning, some degree of accuracy. So like immaterial has nothing to do with the material in your job site. Like materially misstated, I'm sure you guys all know what that means, but it just basically, materially means it's way off. Immaterial means it's not off enough to worry about. So your CPAs generally don't deal with pennies. even though they want your bank recs to be to the penny. They're probably not going to spend any time making sure it's to the penny. They're just going to complain that it's not to the penny because they would charge you $100, $200 or more an hour, right, to look for a penny, which doesn't make any sense. Okay, so anyway, so hopefully you're close. Then we come back over here to this direct costs and burdens analysis report, and you should be perfect. And you're 3 cents off. So now the question becomes, is this rate accurate, the $37? And your answer is, well, yeah, it's accurate because I have no over under allocation of indirect costs. If I refresh this income statement, it's as accurate as I can make it. I mean, the theory might, it's not an exact science, but at least it's what, it's what's accepted out there. It's the best way to do it because there is no perfect way to allocate your indirect costs. It just has to be reasonable. So this is a reasonable way, and this is, in practice, this is generally what's done. Okay, so the actual hourly rate was $46, not $38, so that's quite a difference, right? So important to true up your indirect costs. And hopefully you don't have that much of a difference. There's just not a lot of data in this data. There's not a lot of, the numbers are all real small here, so the difference was quite a bit because of that. So your over under allocation of indirect costs come up every month on your financial statements. So I'd encourage you to make sure you do go through your tested balances, and there's a webinar on monthly financial statements. And you don't want to just print out your income statement, balance sheet, summary contracts, make sure everything ties in and ship it off. Well, just because it ties out doesn't mean it's accurate. I mean, if you have problems with your agings, like you have payables that really aren't payables, or you have receivables that are bad, or if you have, if you have a large over under allocation of indirect costs, your burdens are off, and maybe you need to try to true them up from the beginning of your fiscal year, and you can do it multiple times. You can say, okay, in July, I want it done, I want it retroactively to the beginning of the year. Talk to your CPA and make sure they're okay with it. But retroactively at the beginning of the year, perfectly allocate my indirect costs through July. And then I would come over here, let's say and I would say, okay, well, through July we had a percentage, and let's say these were July's numbers. The typical thing that I would do is I would say, okay, let's true it up through July, and let's come in here and let's put in our percentage, right? So we have, for example, 65.2131. So then click OK. So now going forward, it's going to burden those costs. It only does it when you process payroll. It looks at this percentage burden under preferences. It doesn't go back if you put a number in there. The only way to go back is to use the utility to retroactively allocate it. Now, you would never retroactively allocate beyond the beginning of your fiscal year end. One thing that we've gotten a lot of support calls on is, why does the system give me a nag screen telling me my books have been open for too long a period of time? And from a best practice standpoint, you should close your books when the trial balance is pulled by your CPA. No one should have a 2012. If you're a December year, and you should not have 2012 open at all. And theoretically, you should close it every month after you do your tested balances. So manage your books through your financial statements. The concept is just that. Or manage your company through your financial statements. If you know what your bottom line is, you know what and you've set, what you think is failure, and you're monitoring whether you're meeting that minimum amount of net income to justify your risk of being in business or break even or whatever you set as a criteria for failure. If you're monitoring that every month, then you're aware of what's going on and aware of what you're doing. At a client, I'll tell you a story about a client I had. We did an interim for him every year, and every year was, for like 3 or 4 years, it was the same story. We'd go in, we'd do the interim for June 30th, he'd be losing money, and he would get upset about it, and by the end of the year, he turned it around. He made, he knew how to make money. He was a good businessman, a good contractor, and he could make it happen. At the end of the year, he will have made money. Then he would slack off, and then the next year would come around, we'd do an interim, and he'd be losing money. And then he'd get upset about it. And so my point is, better to get upset about it after month 1, month 2, month 3, than the cycle he was going through. So if he had a test of balances done every month, and then he would know, okay, at the end of every month, where am I at? How much money am I making? And really, it comes down to the test of balances and the summary of contracts. So if somebody's going through your payables and receivables and your bank rec and making sure that those all tie in, if your balance sheet's accurate, then your net income's accurate. So besides, the mechanical things that you can go through, and there are checklists that we produce and to help you produce and make sure everything on here is right. The real trick is your summary of contracts. So on your summary of contracts, are your margins reasonable? And as long as they're reasonable and your job costs are tying into your income statement, then your bottom line is fairly accurate. And, so you want to get good at that process. You want to get good at being able to get a feel for the accuracy of your financial statements. So then then you're allocating periodically during the year to get this number to a zero state so that you can answer the questions, what rate should I be using in my estimating process? How do I get that rate down? It gives you the ability to ask and answer questions. If you have your accountant in front of you and you're bouncing ideas off of them, you want to have the tools that give you the information, and it's really simple. It's a small list of items you really need. Are my financial statements accurate? How do I know that actual rate that's in my estimating, that I'm using in my estimating process is reasonable? So. Okay. So what does the balance in the revenue account labeled over under billings adjustment consist of? So here's just a mechanics issue, a mechanics concept with the system. So we have the summary of contracts, and then we have the income statement. And one of the things that we do well is we take care of the mechanics of getting your job cost and your summary of contracts done, right? So it takes 5 minutes to tie out your summary of contracts and to present something that's going to support your income statement. It should take a lot longer than 5 minutes to make sure these are all very reasonable. So, and on a job that's of a short duration, I feel like 15%, 20%, owner, project manager, estimator, they should be able to give you a number that's fairly reasonable. Make sure that they're doing the gross profit versus the margin. Remember, the income statement and these reports will come out based on margin, not gross profit. Estimators think in terms of gross profit if they're taking the cost, marking up that markup that they apply as a gross profit percentage. It's a percentage of cost, not a percentage of revenue. So this summary of contracts, you can actually generate it as a percentage of cost. So you say, so if the estimators are thinking in terms of their profit and overhead number in their estimate, so they're traditional, they take their cost, they add a profit and overhead number, and then they get to their estimate. Traditional estimating. Okay. So in this process, it's one of the parameters. You can say percentage of cost of revenue. You say percentage of cost. Okay. So there's our cutoff date, job status, percentage of cost. So then over here on the right-hand side, it says a percent when it says cost rather than revenue. This is a percentage of cost. So this is the number they look at. So when you print this out and you have a bunch of small jobs you want them to give you a number on, they'll be familiar with what happened in the buyout process. They'll be familiar with what crews are on which jobs. Some guys do well and some guys don't do well, that kind of thing. And you'll be able to give you something reasonable. And that's all you need on a small job. On a larger job, this is what you want. You want this number to be reasonable, and you want this number to be supported by two concepts. You want your budget actual variance on your labor hours and some sort of projecting mechanism like we have in that jobs. Let's see, where is that report at? In that job status hours report. And the second thing you want is by line item. Let's just go here. you want the accountability done on every line item with, what's my balance of my commitments? Did I buy the whole line item out? What's my total projected cost? So I have a balance here of $19,000, and they have $10,000 left to finish the job. Well, I have $19,000 in commitments out there, and I have $10,000 left to complete it. That doesn't make any sense. Why is that? Let's say they have 15. Let's go to a different example because that throws us into a negative. Or they have a negative to complete. Anything that doesn't make sense. But this is, I think, so that would make sense. We have 19 in commitments. We have total. So let's say they have a balance of 12 here, no actual cost, and they say 7,000 to complete. All right, so that doesn't make any sense. So make sure your balance is higher than your total estimated cost. And maybe they've got something to return, or they have, they're going to do a negative change order on that PO. We'll get those posted. So one thing that we take support calls on, and this is a great support call because people are in tune and they are what's going on. They'll look at those job status reports and they'll say, why do I have numbers in these columns? This is all done. Like a job, it's easy at the end of a job when you come in here and you say, okay, this job's completed. Why do I have anything in my balance on my commitments? I shouldn't have anything. I want them off. So I don't want anything in here. I need to do negative change orders to those line items and those POs, those subcontracts, or do something with them, get them off so that as an organization you get really good at managing this concept, the POs, the subcontracts. So in being a stickler for detail with that area, I think, and if your process includes really monitoring those commitments, then you're going to, in the long run, you're going to have control. You're going to get good at that whole process. It turns my stomach when I see a company that's, about to go out of business and you look at this kind of report and it's not maintained at all. They have no handle on what's out there in commitments. They went out, they did the commitment, and they didn't do more than that. They let the accounting come in, but there was not really an evaluation on a periodic basis or a weekly basis or whatever. And so then no wonder they don't have control, and they're doing $500,000 projects, and this kind of a report's a mess. Well, how much of the black market's getting their materials, right? So, and how much of their hard-earned equity are they losing? So we were going to answer that question, what's that over-under billings account consist of? And the answer is, this is a support question that comes in all the time, actually. So this is going to be the billing. Anything that goes through revenue, it gets the billing. We've got, in our system, we talked about this before, we've got these revenue and expense account types. So on the 4,000, that's default chart of accounts, that's job revenue, requires a job number. You can't put a journal entry into that without a job number. Everything that hits that's considered a billing. And if you do a manual cash receipt to job revenue, it's considered part of billings, and that's appropriate. And it's very, very tightly done, and it has to be tightly done. Now, this non-job revenue is for over-under billings, okay? And that's what it's all, that's the only thing it's for. Sometimes people use it for different things, but that's, they have different types of businesses, and if they have a construction business that, where you should be accruing over-under billings, they're not using it correctly. So this consists of two numbers. It consists, we get the call in and say, I accrued my over-under billings at the end of my period, and the difference here is $43,000, right? How come this is not $43,000? And the answer is because this consists of two numbers. This consists of the reversing entry at the beginning of the fiscal year, and it consists of the accrual at the end of the current period. So if you go into that account, you'll see that. Crazy slow, huh? Okay, so we have there's our reversing entry. Actually, this is demo data, so it's kind of goofy. But you should see a reversing entry and then an accrual. So our accrual at the end of the previous year, the reverse, it was actually these two, this was an accrual in the middle of the month. And by the way, just so you know, you can tie your books out on any day of the month in our system. And that's something that's not out there in many systems. Not too many systems will do that, basically, by any day. Not that most people don't need that, but it will tie out. So I'll reverse those two mid-month reversing entries so it's clear. Okay, so what you'll see is you'll see a reversing entry, like that's the previous year reversing. Here's the end of the month accrual, and there's the February 1st accrual. Okay, so that's what you should see. Now, if it's July, you'll see the only numbers, everything will be in and out. See how January's in and out, you'll have February in and out, March in and out, June, so on and so forth. And this will be every month, it'll come back down to, after the reversing entry, it'll be just the reversing entry at the beginning of the year. And then when you do your accrual at the end of the month, those two come together to make the $12,000 in this example, 12,000 here. Okay. So that's what that consists of, two numbers, not one. Not the end of the month accrual, but the beginning of the fiscal year reversing plus the end of the month accrual. What dashboard report, sub-report can be used to help with labor hours, cost control. And we've shown that several times. It's the job status projected column on the job list. So if you, in a month, or 2 weeks hopefully, or you say, I want to look at that and compare that to the process I'm currently using, you can bring this data up and go through the session 3. You'll find the question and the answer, okay? So it's this projected column right here. And that brings up the job status hours. What report splits out labor rate variance from our labor production variance? And that's, we showed you the job cost. Number 3, job budget reports. Number 6, print labor performance, and then extended. And it's got, you know, the name on it. It's probably not as good as it should because we've added to the report. It used to just be labor, and we added to it all the other types because somebody requested it, and it made sense. So that's it. That's the labor. That's this report here. So I like that report because it gives you both. What do blue numbers on a report indicate? They mean that there's an on-demand sub-report that will come up in a separate tab that will support the blue number. So an on-demand sub-report is really just a completely different report. Like if you look at this hour status report, it's got completely different headings than this report. So drill down to detail now, like here we drilled down. If I drill down on this line item, this is drill down to detail. Pretty much the same column headers, actually the same report. It's not a different report. So I can take any of these reports in the menu system, and I can make it a sub-report to this dashboard report. And you can do that with it. You can make any base level report. I could put sub-reports in here all over the place. And with the blue number, I would change them to blue. You'd actually dictate that with the Crystal reports. So, I mean, I would encourage you to take the Crystal reports webinars. They're complimentary. They're, it's an investment in learning how to do some of those things. And it's not necessarily learning that's important. It's understanding what's possible, maybe is the best way to say it. So a lot of organizations spend a tremendous amount of time and energy and resources developing and working with spreadsheets. If you're doing that, you need to take the webinars because Crystal can do virtually anything Excel can. Excel is hard to beat in some ways completely, and I'm sure everybody realizes that, but the more you're doing with Crystal rather than Excel, the more money you're saving on your overall process. And if you're keeping it simple, it's not real hard to maintain. And if people are transferring things to Excel and manipulating, moving them around, you have a lot more room for errors and kind of thing. Okay, what should your monthly financial statements consist of? They should consist of three things: a balance sheet, an income statement, and a summary of contracts. And so, like, so we show the income statement here, the summary of contracts is down here, and then the third component would be the balance sheet. Okay. Okay, where's the summary of contracts? Summary of contracts menu item. It's under job costs, summary of contracts, print summary of contracts. If costs for one period get posted in a subsequent period, what is your hit to the bottom line? Okay. Hit to your bottom line is the gross profit on the cost reported in the subsequent period. So here's the concept. Okay. I was doing this audit one time, and the payables were abnormally low. So December payables were much lower than November's and October's, and the job was going, and it's like, okay, why are the payables low? Doesn't make sense, right? I mean, it's possible, but it's probably so trying to resolve that. What the company was doing, they were trying to make their financial statements look better, so they basically hid a bunch of payables. And so their summary contracts, they were basically overbilled on everything. So we were basically removing revenue from their income statement because their costs, their billings exceeded the cost plus the markup on their billings, which would happen if you didn't put any payables in. Let's say you put no payables in your December. Well, you're gonna show that you shouldn't have billed anything for December because you recognize profit on a percentage completion basis based on the costs plus the margin on those costs equals your cost plus profit. So back to the matching principle. Matching principle states if my cost and my margins on those costs equal my revenue, then my bottom line is accurate. If I have a bunch of revenue where I don't have the cost, so I'm showing a certain margin, right? So anyway, you're going to be overbilled if you're missing your costs. So even you feel comfortable with them, definitely, right? So the concept is to not treat your accounting system as this way to manipulate the world, way to manipulate what's really going on because it's not accurate anyway. Well, you know what? It is accurate. I completely disagree with those kinds of concepts. If you have a fair financial statement, you're being fair with yourself. One of my clients came to me one time. He said, "I really want to grow, and I'm going to go out and I'm going to get this huge loan." And the guy wasn't profitable, and I said, "Oh, well, don't you think maybe you should try to figure out how to make money on the smaller jobs before you get into the bigger jobs? I mean, you're really going to risk your future." And so figure that out. Figure out how to be more profitable. Figure out how to have more control over your costs. Figure out how to manage your men or whatever it takes. Manage your costs. Get into a market where you can make more money. Develop relationships. Do whatever. Do something different rather than take on this huge risk. So be fair with yourself and fair with the people that work with you, and then people are more willing to work with you. So the bonding companies, when they take a hit, they take a hit. It's huge. And then they come after you because they make you personally indemnify everything, right? So anyway, so doing a big job is not always a good thing. Figuring out how to become profitable as a contractor, that's a big thing. And getting a monthly financial statement that's accurate, that's a big thing because then you move forward into the future with your eyes open, knowing where you're at. Okay, what is a full summary of contracts? And a job schedule that includes all the jobs worked under the fiscal year. It includes over/under billings computed on the open jobs, and it includes totals that tie into the income statement for your total cost and your total revenue. And I think that's a big deal because it proves your income statement, proves your over-under allocation of indirect cost, and the over-under allocation of indirect cost is what needs to, it answers the question, how far off is my actual job cost from the job cost for showing up on my job cost reports? The difference is your over-under allocation. So if you do a full summary of contracts, it proves this number. It just basically clarifies everything. This is really a simple picture, and if you're not real familiar with it, if you look at it, for 3 or 4 months and really study it, it'll become very elementary. So nothing's complicated as long as you get real familiar with it and break it down, right? So the summary of contracts, these are all job-to-date numbers, right? You say, well, how do job-to-date numbers tie into my year-to-date income statement? And the answer is, at the end of the previous fiscal year end, you subtract out the numbers that carried into the current fiscal year. So for in this case, this demo, the 2012 numbers are all getting subtracted out here. And the mechanics of this, it's built to do that, okay? So these job-to-date numbers become year-to-date numbers when that gets subtracted. And we're a little bit over on time, so we're going to try to wrap it up. Okay, so why do we accrue over-under billings? To adhere to the matching principle. Okay, so we've reviewed over-under billings concepts. In our next session, we'll talk about budgeting, bottom-up budgeting, top-down budgeting, and break-even analysis. And so if we have, just to kind of give you a heads up on the concept, so we want to bring this like full circle, right? So we've talked about supporting the estimating process. We've talked about the job cost reports we look at and how they tie into the income statement, and how the income statement proves our job cost numbers, improves our hourly rates on our employees that we're bidding, which is a big deal. But how do we look forward? How do we look to the future with those numbers? And so on our budgeting models, and this is actually, and these are excellent concepts, and these aren't concepts I came up with, but you're left with them in this webinar. So we'll be studying these concepts. So from a standpoint of looking forward, if you don't look at the spreadsheet but think in your mind's eye, how much do you think in business do you think you'll win this year? And let's say it's $5 million, and you say, well, what kind of margin are you bidding? You've got your your profit and overhead, right? So you've got your job cost, you've cut it in. Here's your gross profit concept. So let's say you think you'll win $3 million. And so, and you're bidding it, the guys are saying profit and overhead 20%. Well, what do you expect? Well, if you're doing $3 million, you're going to probably bring in about $500,000 or $500,000 in profit and overhead. Okay, what's your overhead? And if it's $500,000, then you're bidding to make no money. That would be a break-even analysis. But anyway, so what am I bidding toward? Let's say we're going to do over $5 million at 20%, and our overhead. And so, almost a little less than, $5.5 million times 20% is $950,000. Overhead's $500,000. So I'm bidding to make $400,000. So looking forward, what am I bidding to? What's my bottom line I'm bidding to? So that's a valid concept. Very simple computation, right? So we'll talk about that. We'll talk about top-down budgeting, bottom-up budgeting, break-even analysis. And then we'll talk about, so this one's all based on gross profit concepts. So you can manipulate your numbers. Take this and you say, make a copy, right? And it puts a copy in your Google Docs. And then you can take this and make it your own. Put your numbers in here. And we have some clients that do that. I'll talk to people almost on a regular basis now, and they'll say, I'm using that, and that really helps me kind of see where I'm at, helps me set goals for where I'm headed. At least I know kind of where I'm headed now, that kind of thing. And maybe you have an idea of where you're headed, but these are some real simple spreadsheets. So this one's based on margin, and this one's based on pre-tax margin. So we'll work on how to use those next time. Anyway, I appreciate you guys sitting in on the webinar, and we'll talk to you next week.